Hi, I'm Jeff Bermet, and along with Nick Davis, we're the co-managers of the Libero Cautious, Dynamic, and Solutions portfolios. July was a good month for global equity markets and a good month for our portfolios as well. I think the major news was President Trump sort of dialed down the rhetoric and the tension on the trade front by achieving trade deals with Japan, the EU, and South Korea. The dust is settling around tariff levels in the US of between 15 and 20%, which is quite high. This brings us back to the levels of the late 1920s and early 30s, when, of course, we had the Great Depression, aggravated by, I would say, global trade tensions and retaliation. They settled on 15% deals with the EU and Japan and South Korea. But what was most favorable, I think, was there was no retaliation by the EU or Japan on any US exports to their countries. In July, the CPI number that we received, so the inflation figure we received on the US for June, started to show significant evidence of certain good prices going up, clearly responding to tariffs. We have gotten some earnings news from big companies citing tariffs causing problems. Both GM and Ford cited billion-dollar hits each on their earnings from the tariffs, and some other consumer product companies have all hinted at weakness in some segments of their clients because they are unable or unwilling to pay higher prices that they're seeing, and some of the pricing may be because of tariffs. And then on Friday, the 1st of August, when we got the labor market report for July, that showed a substantial reduction in the pace of new job creation. And so that raised the question of, is the US economy slowing down? And with the price pressures, are we seeing perhaps the early advent of some sort of stagflationary environment? And Trump's response was incredibly hostile. He claimed the figures were rigged and that the head of the Bureau of Labor Statistics, who produces these numbers, had manipulated the numbers for political purposes, and he fired her. The combination of waiting to see what these impacts from the tariffs are, and then the president beating up on the Fed and potentially threatening or raising the question of distorting US economic data to make his programs look better, makes us feel really comfortable continuing to hold fewer US stocks than these funds have held in the past, and to certainly hold fewer US dollars than we've held in the past.
So tech stocks have had a fantastic run this month, and we have some exposure to these companies. I think one of the things that still sits in the back of our mind is the expenditure on AI. On the other hand, Meta is spending $100 billion next year, and that's the equivalent of the German defense budget, which, as you know, has been expanded to meet the ongoing resurgence in NATO spending. These figures are huge, and I think putting them into some sort of perspective gives us a feel for how much is being driven by private companies from their own cash flow into the AI race for dominance. On the other side of that, we've seen the positions we have in Microsoft do well because of the growing demand for data storage, which we see as a key element of the whole AI story. Data storage is going to be key, and also energy. And energy is one of the areas we've looked at in the portfolio. We have the exposure to the utilities through SSE and the direct portfolio in our direct holding, and also through the European Utilities ETF position. Away from the tech side, we've had some good results in the financials, with banks being strong. Commerzbank has continued to be a really good investment for us as the ongoing potential will they, won't they bid coming through from UniCredit. We look forward to seeing how this plays out, and we've done very well out of this position in Commerzbank. And so much so that we like European financials that we're looking to add ING into the portfolios. Again, a bank trading on very attractive levels of earnings and a very strong income stream of about 5% and a very low risk volatility. Again, we're looking to use this to play the yield curve where rates are coming lower and the longer end rates remain higher. This is the same play we're seeing in the US and in the UK and in Europe. One area we've talked about extensively over the last few months has been defence, and this month this sector's been relatively sideways. I think after the strong rise we've seen earlier this year, this part of the portfolio has actually just kind of trended generally sideways, as we're really waiting to see the impact of the NATO spending decision that has happened and seeing the awarding and signing of the contracts that come through from that. Jeff touched on the concerns about expenditure from consumers. And one of the companies we hold is Nestle, and this is a bit of holding we've had for a while, and the performance has not been particularly exciting. And concerns about consumer expenditure on branded goods has been a concern we've been looking at, and therefore we took the decision to sell this position. We've used the funds from this to buy the holding in ING and increase our exposure to European financials.